Good day, guys. Welcome to another exciting episode of the WealthWise Show. I'm your host, the Wise Investor, and join me as we navigate the world of personal finance and equip you with the knowledge and tools to make wise financial decisions. Now, let's dive into today's episode of the WealthWise. Alrighty, guys. Welcome to another episode of the WealthWise Show. I'm your host, the Wise Investor, and I greatly appreciate you joining me in. I'm not going to recap the intro, but just as some housekeeping, this is the WealthWise Show, and me, the Wise Investor, Derek. This is for educational purposes only, guys. This is not meant to be taken as financial advice, and none of the opinions I have is a reflection of the opinions of Simplicity Wealth. My opinions differ, and these are my personal opinions, and my personal opinions are not financial advice. Typically, I'm not going to give 100% of my opinions, but I may say something about a company or two, and just keep in mind, those are my personal viewpoints. So with that being said, what is today's episode about? If you listened to last week's episode, at the end, I was talking about how today's episode is going to be about the Russell. And what is the Russell? What is the Russell 3000 index, 2000, 1000? What is that? So the Russell 3000 index, it is part of the FTSE Russell that provides exposure to the U.S. stock market. The inception of it was January 1st, 1984. So it's a newer index, It's an index that's not as old as the Dow, not as old as the S&P, and that particular index measures the performance of the largest 3,000 U.S. companies, representing approximately 96% of the investable U.S. Equity market. So, what is the Russell? I just explained it to you, and of course, by the way, I read that from Investopedia, and a lot of the fact finding and points is from the Investopedia. So that is the Russell 3000 as a whole. But the Russell also has different indexes. One for large cap, which is the Russell 1000, and then Russell 2000, which is the small cap. So those are the subsets of the Russell 3000. But why is the Russell is, to me, one of the best, I would say. I'm not going to say the best. I'm definitely not going to say that. But one of the best indexes for finding companies. I'm not going to really say investing in the Russell as a whole is a great idea, because that's up to your personal financial decisions and journeys, and who your money managers are, your advisors is, and all that good stuff. But I am going to say you can find a lot of great companies to invest in using the Russell, and in particular the Russell 2000. So the Russell 2000, like I said, is a subset of the Russell 3000. But the Russell 2000, and I'm not going to talk about the Russell 1000 because those are large caps. We've been talking about those for a while now. But I want to talk about the smaller companies, the companies that are considered small capitalized companies, and why a lot of people overlook it, and why a lot of professionals on Wall Street and investors, accredited investor, hedge funds, why they love the Russell 2000. So understanding that the Russell 2000 was, it's part of the Russell 3000, but it's its own thing. It has 2,000 of, like I said, the small cap companies who capitalization is in the millions to, maybe $1 billion. So the reason why that is important, because those small companies usually turn into mid cap. I was going to say big companies, but no, they usually turn into a mid cap company. And they usually then go from a mid cap company to a large cap company. So, are you starting to catch my drift? If not, I'm going to walk you through it. So, I was going to say, like Apple. Apple, for example. Apple, when it first started, it was not the giant juggernaut it is today. It had to grow. It had to have investors. It started as a small cap company. And that is the secret key of why I like the Russell 2000, me personally, is because when you start researching the different companies in the Russell 2000, and you start, I know 2000 is a lot. Trust me, I know. But you don't have to do it all in one weekend. You take your time, research a couple of companies here and there. Best rule of thumb, I would say the new companies that come into the Russell, I'll look at those, and then the top 100 companies of the Russell, I'll look at those. So new companies that come in, and then the top 100 companies, I'll look at those. And then what you'll find in researching those particular companies, that, hey, these companies are primed and have potential for growth. And usually their share prices is not going to be large cap type of share prices. So if you buy a share of Apple today, you're going to run you almost $200 a share. But if you go with a smaller cap company, a company who is growing, you might pay $20 a share. Now, I do have to preface this with saying that the Russell 2000, because it's a small cap index, that means there is considerable amount of risk. I'm talking about you need to consider every variable when it comes down to the investing in companies in the Russell 2000. The Russell 2000 is not meant for people retirements. It's not meant for like, hey, I'm going to throw all my retirement money in the Russell 2000. No. And the reason being is because these companies are newer or smaller, they have more room to fail. They have more room to not be profitable. They have more room to lose investors. They have more room for, making considerable amounts, or they have more room to forever, but they have less room forever, really, because they don't have the same amount of capitalization as the large cap. So when you're researching these companies, you really got to do some research. And, I know that is a fancy, or a lot of people in this industry, they say, oh, do your research. No, you really need to do your research on the companies that you are thinking about investing in with the Russell 2000. But if you do your research and you find a particular company that fits your investment goals and your investment needs, and you actually hone in on learning everything you can about that company, its industry, its competitors, and you start branching out, you may find, not saying you will, but you may find a company that will give you that 5x, that 10x, if you hold it for a considerable amount of time, because those companies are typically going to be in the growth stage. And so if they're in the growth stage, let's say they're valued at 500 million, that's small cap. But what happens when they get to, 50 billion over 10, 15 years? Now, 10, 15 years is a long time, but if you're trying to invest, you should understand that, this is not a get rich quick thing. It's going to take time. And the company is going to have its ups and downs. It's going to have to prove itself. It's going to have to go through economic downturns and all that stuff. But that is one of the main points of why, it'll be inexpensive. It'll be, if you're buying a share at $20 a share versus 200, all right, I'm not going to put my entire portfolio in this particular small cap company, but I'm going to, nibble. I'm going to throw them a couple of dollars, and then as they grow and I see that they're proving themselves, earnings are looking good, even if they miss Wall Street earnings. And that's another thing that a lot of people who are not in this space, just because a company misses its earnings does not mean it's a failure of a company. And when I say miss, it missed Wall Street's expectations. But let's say the company misses Wall Street expectations, but it still produced growth. To me, that's still solid, because you're still showing growth. You might not have grown the way we expected, but you're not regressing. You're not taking on more debt than you're bringing in income. You're not, your balance sheets are looking good. So, okay, yes, you missed Wall Street expectations, but now you're still showing that, hey, yeah, I'm still in this game. I'm still fighting. And that's what I like in smaller capitalization companies, because it shows that, hey, even though we deal with hardships, we're adaptable. We're able to conform to any situation that's thrown at us, and that will allow us to become a mid-cap company in X amount of years. So when the CEO comes out and says, hey, things are going to be a little tight, but hey, look at it, you can see that we're still doing what we're supposed to be doing. We're still fulfilling orders. If it's, that type of company, we're still doing X, Y, and Z. We may have laid off some people, but it was because X, Y, and Z. Then, all right, I'm still going to be invested. And that is how, when you are looking at any company, you should be. So don't just do that with small capitalization company. Even if it's Apple, I still want to see, I want to hear what the CEO got to say. I want to see what your 10K say, your 10Q say. I want to see any filings. I want to see how these lawsuits are going to go. Like, even if it's a large capitalization company, a company that you know forever, still do your research. So basically, I'm saying do your research. This is a long-winded way of saying do your research. And doing your research in these small capitalization companies in the Russell can bring out some amazing gems for the future. Now, of course, like I said, small cap companies are extremely risky. Extremely risky. I'm going to say it one more time, like I'm a DJ. Extremely risky. That means you really need to sit down and think. You need to talk to a professional. If you have a financial advisor, talk to them. If you don't have a financial advisor, seek out someone who is credible and talk to them. And make sure, you do your research on them. And not only do your research on the particular company you're looking at, do your research on their competitors. Because you might find their competitors might be better. I don't know. And their competitors might be a mid-cap company and it just might be better. And so, it's one of those things where still, at the end of the day, great opportunity in the Russell, especially going into 2024. I want to preface that. Because the thing about small caps, because they're small, they need a lot of investors, or they take on debt. They take out loans just like any other businesses would. They sell bonds just like any businesses would. And right now the interest rates are higher. So what happens when the interest rates start to go lower, especially since, Fed Chair Powell said that they're thinking about 3 rate cuts next year. So if they're thinking about 3 rate cuts next year, depending on how much they cut, what is that going to do for smaller capitalization companies that, basically live off of debt? And they've been growing in a high interest rate environment. Yeah, they might not have reached the Wall Street expectations, but their balance sheet looks great. Their CEO and their, the head of the company looks great. All the people who are running the company, looks great. And they're still showing growth. It might be small growth, but they're still showing some growth in a high interest rate environment for a small capitalization company. So if you can find a company like that in the Russell, and you can do your research on them and their competitors and whatnot, you may find, a gem. And so, I would say the Russell, if you want to set it and forget it, talk to your advisor about that. But I was going to say the S&P 500 and the Dow are those type of indexes where, hey, I don't really want to pay attention to this too much. I just want to collect my earnings, collect some dividends, and call it a day. But if you are more like, hey, I really like this finance stuff, and I really want to know more about, I want to get into it. Or you might be even say, hey, I want to do this professionally. Well, do the work and looking into other companies besides the big companies you hear on CNBC all day. And there's nothing wrong with the company that you hear on CNBC, but I'm saying if you want to do this, like if you really, hey, I really am about this life, I want to do this, then do your research on other companies besides the ones you hear. Do your research on the companies that support the big companies. Like, I have he doesn't know he's my mentor, but I consider him my mentor. His name is Q. Great guy. He works up in Wall Street. And, that's one of the things I've learned over the years of, watching his stuff, talking to him, is do your research. Like, and not just some simple research, really dig deep into that company and really dig deep into their competitors. And if you see something on TV that, I wonder what they do, go do your research on it. If I'm driving down the street and I see a company that I've never seen before, I'm going to do my research on them, especially if they're publicly traded. And one of the things I learned from Q was also don't just look at the big companies like Apple, Microsoft, and all that stuff. Look at who their suppliers are. Look at who their transport are. Like, look at their partners. And 9 out of 10 times, their partners may be publicly traded. So if this big company is making money, what are their partners also doing? And typically their partners are going to be less costly when it comes down to shares. So, that's what I'm saying. Just do your research. So I guess it's turned into do your research instead of what is the Russell 2000 or the Russell 3000. And I would talk about the Russell 1000, but it's just the large cap stuff. And I've been talking about large cap stuff for months now. Well, to me, it feels like months. So let me see the time. We're at 15 minutes, I think. Maybe. I don't know where we're at. Oh, okay, I see. I'm just going to assume it's 15 minutes. All right. So 15 minutes. I don't know. I really don't know because I'm not going to lie to you guys. I recorded this back to back with another show. And the time is all timey-wimey, wibbly-wobbly. So if you don't watch Doctor Who, never mind. Anywho, I appreciate you guys listening. For the new year, I've already said it before. I'm going to say it again. We're going to be doing, drum roll, videos for our shows. So that means more production for me. And I'm the only one doing production. I'm by myself here. It's me, computer, and software, camera. So that means, I already got, I think, 6 shows recorded. I was in Atlanta this past month in November, and I was there for a little bit. So, technically it was like a vacation, and technically I was working on vacation. But, to me it felt fun. So, I did 6 episodes when I was in Atlanta. And then when I put those episodes up, I'm going to be working on more episodes. I'm going to try to get at least 6 to 8 episodes a month out. And when I mean out, I mean I get them, I record them, and I edit them and all that stuff, and then I will schedule them to come out periodically. That way, we can still work on the episodes, especially this video. I can still work on them, as the days go on, and they kind of, spruce them up, I guess, make them look good, make them sound good. And if I need to re-record something, it gives me time to re-record something. So it's going to be a fully productive show. And, shout out to the 85 South. They are why I had this idea of pre-recording shows and editing. Well, if you watch them, Joe, he don't edit, but editing them and making sure that, hey, when I put out stuff, I can put it out and still do my day job and still do my family stuff, still travel. So, this is the format I'm going to go with. So shout out to them. Shout out to Q. Shout out to everyone who assisted with me on this journey this year. I greatly appreciate it, guys. And next year, we're going to rock and roll, and we're going to be even better. So with that being said, I appreciate you guys listening. I'm very grateful. Be safe out there, and I'll see you guys next time. And until next time, stay WealthWise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the WealthWise Show